Listen to me very carefully, because the financial security of the person you love most is hanging by a thread, and you might not even realize it. Right now, there is a hidden tax trap waiting in the shadows of the year 2026. And if you and your spouse do not move for specific assets before one of you passes away, the Internal Revenue Service and your state tax board are legally positioned to confiscate a massive percentage of everything you have spent your entire life building. I know that sounds like an exaggeration. I know you want to believe that the money you saved, the home you bought, and the investments you nurtured are safely locked away for your family. But the reality is far more brutal. When you lose a spouse, you don't just lose your life partner. You lose your tax filing status. You lose your unified financial shield. And if you are not strategically positioned for the massive tax law shifts coming, the government will step in as your largest unintended beneficiary. If you want to protect your husband, your wife, and your children from a devastating wealth transfer tax, you need to hear every single word of this video. Smash the like button right now so the algorithm pushes this critical warning to other families who need to hear it. And make sure you hit subscribe so you never miss out on the wealth preservation strategies that the ultra-rich use every single day. Now, let us talk about exactly what happens when a spouse passes away, because the financial industry rarely explains this in plain English. Most couples operate under a massive misconception. They believe that because of the unlimited marital deduction, when one spouse dies, everything simply transfers to the surviving spouse completely tax-free. And while it is true that you can pass infinite assets to a U.S. citizen spouse without triggering an immediate federal estate tax, that is only half the story. The real danger is what happens to the surviving spouse the very next calendar year. This is a nightmare scenario known in the tax world as the widow's penalty, and it is the single biggest destroyer of retirement wealth in America. When you are married, you file your taxes jointly. That means your tax brackets are wide and forgiving. You can have a substantial amount of combined income before you hit the dreaded high tax brackets. But the moment you become a widow or a widower, everything changes. The very next year, you are forced to file as a single taxpayer. The income brackets are immediately cut in half. But here is the devastating part. Your income does not get cut in half. You still have the same required minimum distributions from your retirement accounts. You still have the same rental income. You still have the same dividend payouts. So now, you have the exact same amount of money pouring in, but it is being squeezed into a tax bracket that is half the size. This automatically pushes the surviving spouse into a significantly higher tax bracket, causing their income tax bill to explode precisely at the time when they are most vulnerable. And this problem is about to get exponentially worse in 2026, because temporary tax cuts are sunsetting, meaning individual tax rates are going up across the board. If you do not move ahead of this, your surviving spouse will be financially suffocated. This brings us to the very first asset you must absolutely move, restructure, or convert before a spouse passes away, and that is your pre-tax retirement accounts. I am talking about your traditional IRAs, your traditional 401 kiloseconds, your 403bs, and any other account where you have deferred paying taxes. These accounts are ticking tax time bombs. When you or your spouse passes away, the survivor inherits that massive traditional IRA. Eventually, the government mandates that you must start taking required minimum distributions because of the widow's penalty we just talked about. Taking those forced distributions as a single filer in the post 2026 tax environment will subject those withdrawals to massive federal and state income taxes. And heaven forbid the surviving spouse passes away and leaves that traditional IRA to your children. Under the current rules of the Secure Act, your non-spouse beneficiaries, your kids, are forced to empty that entire account within 10 years. Imagine your son or daughter who is likely in their peak earning years, suddenly forced to take hundreds of thousands of dollars in distributions on top of their regular salary. They will be pushed into the highest possible tax bracket, and state and federal taxes could easily wipe out 40 to 50% of that inheritance before they even get to spend a dime. So what is the solution? What do you actually do with this asset right now? You need to systematically move that money out of the traditional pre-tax environment and into a Roth IRA while you are both still alive and married. This is called a Roth conversion strategy. By converting chunks of your traditional IRA to a Roth IRA right now, you are voluntarily paying the income tax at your current, favorable married filing jointly tax rates. You control how much tax you pay. Once that money is safely inside the Roth IRA, it grows completely tax-free forever. When one spouse passes away, the survivor inherits the Roth IRA, and when they pull money out to live on, it does not cost them a single penny in taxes. It does not affect their tax brackets. It does not trigger the widow's penalty. And when your children eventually inherit that Roth IRA, they still have to empty it in 10 years. But every single withdrawal they make will be 100% income tax-free. By paying the toll to the IRS today, while you have the protection of the married tax brackets, you are shielding your spouse and your kids from a catastrophic tax bill tomorrow. If you are finding this strategy valuable, and you are starting to see how these hidden rules can destroy your wealth, please take 1 second to drop a like on this video and subscribe to the channel, because the next 3 assets are even more heavily targeted by the government. The second asset you must carefully reposition before a spouse passes is your highly appreciated real estate. This includes your primary residence, your vacation homes, and especially your rental properties. Real estate is where most families hold the vast majority of their generational wealth, but it is also where they make the most devastating estate planning mistakes. The way your property is titled dictates exactly what the IRS can take from your family. Let me explain the magic of the step-up in basis, which is arguably the single greatest tax loophole in the entire United States tax code, and how easily you can lose it. When you buy a house for $200,000 and decades later, it is worth $1 million. You have $800,000 of taxable phantom profit called a capital gain. If you sell that house while you are alive, you owe massive taxes on that gain. But if you hold that property until you die, the IRS forgives all of that past growth. The property receives a step-up in basis to its current market value on the day you die. Your heirs can sell it the very next day for $1 million and pay 0 capital gains tax. But here is where married couples get completely destroyed. How you get that step up in basis depends entirely on where you live and how the deed is written. If you live in a community property state like California, Texas, or Florida, and the property is titled correctly as community property, when the first spouse dies, the surviving spouse gets a full 100% double step up in basis on the entire property. The surviving spouse can then sell the home, downsize, or liquidate the rentals without paying a dime in capital gains tax. But if you live in one of the other 41 common law states, the surviving spouse only gets a half step up in basis. The deceased spouse's half of the property gets stepped up, but the surviving spouse's half remains at the original low purchase price. If the widow or widower needs to sell that home to pay for assisted living, or just wants to move closer to the grandkids, they could be slammed with a massive capital gains tax bill. And if you made the fatal mistake of putting your children on the deed while you were alive, trying to be clever and avoid probate, you have completely destroyed the step-up in basis for them. And the IRS will absolutely feast on that equity when the house is finally sold. You must sit down with an estate planning attorney right now. Look at the deed to your properties and consider moving them into a revocable living trust or a spousal lifetime access trust. Moving your real estate into a properly drafted trust ensures that the property avoids the costly, public nightmare of probate court and guarantees that the step-up in basis rules are applied in the most tax-efficient way possible. For your surviving spouse, do not wait until someone gets sick to check your deeds. Fix this immediately. The third asset that can single-handedly trigger a massive wealth confiscation is an asset you probably think is completely immune to taxes, and that is your life insurance. Everyone is taught that life insurance death benefits are totally tax-free. And while it is true that your beneficiaries do not pay income tax on the payout, the IRS has a very different rule when it comes to estate taxes. If you own your life insurance policy, meaning you are the insured and you are the owner of the policy, the entire death benefit is included in your taxable estate when you die. Now, for the last few years, the federal estate tax exemption has been incredibly high, hovering around $13 or $14 million per person. Because of that high limit, most people stopped worrying about the federal estate tax. But remember the warning for 2026? Those exemptions are scheduled to be slashed in half. Suddenly, millions of upper-middle-class families, small business owners, and successful professionals will find themselves right back in the crosshairs of the federal estate tax, which carries a staggering 40% tax rate. But even if you do not hit the federal limit, you must look at your state laws. Many states have their own separate estate taxes or death taxes, and their exemption limits are aggressively low. States like Massachusetts and Oregon have exemption limits of just $1 or $2 million. If you own a house, a retirement account, and a $1 million term life insurance policy, you have just crossed the threshold. And in states like New York, they employ something called a tax cliff. If your state is just 5% over the limit, you lose the exemption entirely and your family pays taxes on the first dollar. This means your life insurance policy, the very thing you bought to protect your family, is the exact asset that pushes your net worth over the line, forcing your grieving spouse to write a massive check to the state government. You can completely avoid this trap by moving your life insurance policy. You must take ownership of that policy away from yourself as an individual and move it into an irrevocable life insurance trust. When the trust owns the policy, the death benefit is completely removed from your taxable estate. When you pass away, the trust receives the millions of dollars in a payout, completely free of income tax, completely free of federal estate tax, and completely free of state death taxes. The trust can then provide that money to your surviving spouse to replace your income, pay off the mortgage, or maintain their lifestyle without the government taking a single penny. Setting up this trust requires a specialized attorney, and you must do it well before you anticipate passing away, because there is a 3-year look-back period. If you transfer the policy and pass away within 3 years, the IRS pulls it right back into your estate. This is why you must move this asset right now. If you are realizing that your current financial plan is full of these dangerous holes, make sure you share this video with your spouse or your business partner right now, because ignorance of these laws is exactly what the IRS is counting on. The fourth and final asset you absolutely must move and protect before a spouse passes away is your taxable brokerage accounts. These are your non-retirement investment accounts, your individual stocks, your mutual funds, and your savings accounts that are simply sitting in your individual or joint names. This is the low-hanging fruit for the government and the legal system to drain your family's wealth. When a spouse dies, if these accounts are not structured flawlessly, they do not just automatically pass to the survivor in a smooth, cost-free manner. If you have an individual account in just your name and you pass away, that account is immediately frozen. Your spouse cannot access that money to pay for the funeral. They cannot access it to pay the mortgage. They cannot access it to buy groceries. That money is now legally trapped in the probate system. Probate is the legal, court-supervised process of distributing a dead person's assets, and it is a massive, expensive, time-consuming nightmare. The court takes a percentage of the gross value of the estate just in administrative fees. The lawyers take their cut, the appraisers take their cut, and the entire process can easily drag on for a year or more, leaving your surviving spouse financially strangled, while the legal system slowly drains your hard-earned money. Even if you have a traditional will, a will is literally just a set of instructions for the probate judge. A will guarantees that your family goes to court to protect your surviving spouse. You must move these taxable accounts out from under the jurisdiction of the probate court. You have two highly effective ways to do this. The simplest method is to add a transfer on death designation or a payable on death designation directly to the account at your brokerage firm. This piece of paper legally overrides your will and bypasses the probate court entirely. When you pass away, your spouse simply presents a death certificate to the bank or the brokerage, and the account immediately transfers into their name without a judge ever getting involved. However, the far superior strategy, especially for families with substantial assets or blended families with children from previous marriages, is to move all of your taxable brokerage accounts into a revocable living trust by retitling your investment accounts so that the trust becomes the legal owner. You ensure a seamless, totally private transition of wealth. When you pass away, you do not actually own those stocks. The trust owns them. And since the trust never dies, there is no probate, there are no court fees, and there is no public record of what your family is worth. Your surviving spouse, as the successor trustee, instantly steps in and has total, uninterrupted access to every single dollar, allowing them to maintain their financial stability during the most difficult emotional time of their life. Furthermore, placing these assets in a trust allows you to build in catastrophic protections. You can ensure that if your surviving spouse eventually remarries, the new husband or wife cannot legally drain those investment accounts and disinherit your biological children. You are building an impenetrable financial fortress around your family's wealth. We have covered incredibly dense, complex strategies today, but the core message is simple. The default financial system in this country is designed to slowly consume your wealth through taxes, court fees, and legal friction when you pass away. The year 2026 is bringing a wave of tax changes that will aggressively target families who are not prepared. You cannot afford to be passive. You cannot assume that just because you are married, your spouse is automatically protected. You must take action. You must look at your pre-tax retirement accounts and start calculating strategic Roth conversions. To defeat the widow's penalty, you must review the deeds to your real estate to ensure you capture the absolute maximum step up in basis without triggering a state tax cliff. You must analyze your life insurance policies and strongly consider moving them into an irrevocable trust to shield that massive payout from estate taxes. And you must retitle your taxable brokerage accounts and savings to guarantee that your spouse never has to step foot in a probate court just to access their own money. This is not just about saving money. This is about honoring the lifetime of sacrifice you have made to build a life for your family. It is about ensuring that your spouse is allowed to grieve in peace, rather than spending their final years fighting with the Internal Revenue Service and probate attorneys over the scraps of what you left behind. Wealth preservation is a proactive choice. I want you to sit down with your spouse tonight. Watch this video again. Take notes. And then immediately schedule a meeting with a qualified estate planning attorney and a fiduciary tax advisor. Bring them these exact 4 points and demand that they build a protective wall around your assets. Do not let the government become the primary heir to your estate. If this video opened your eyes to the hidden dangers in your financial plan, Please subscribe to the channel right now. Leave a comment down below if you have any questions about how these trusts actually work. And share this with anyone you know who is approaching retirement. Your financial legacy is entirely in your hands. Take control of it today. And I will see you in the next video.